Hello viewers, this is where a continuation of where we ended last time, and the previous videos we looked in the previous video we looked at the first type of costing system, and we've seen the target costing, and we said we are going to combine the target costing with the life cycle costing. We get one simulation or one past paper number that involves two costing systems, and we see how we can be able to solve them, and we see how we can also be able to get the difference between them. So let's look at the life cycle costing, the life cycle costing system as our second costing system, other costing systems that we have. So life cycle costing system, this estimates and accumulate costs over the period's entire life. In other words, the period entire life cycle, in order to determine whether the profit, whether the profits and during the manufacturing phase will cover the costs incurred during the pre and post manufacturing stages. In other words, with the life cycle costing, we are trying to trace the costs incurred on a product throughout its entire life cycle. We are tracing the costs that are incurred on a product throughout its entire life cycle. It is very important to do so because at the end of the day, it helps us to keep track of our costs, or we keep knowing the costs that we are going to be incurring in the production of the product from the time we are buying the raw materials. We keep recording all the costs that we are incurring to the point that we produce the finished products. Remember, our emphasis here is going to be on the manufacturing companies, not on the trading companies. Manufacturing companies, they are the companies that have both the work in progress, they have the raw materials, and at the same time they have the finished goods. But the trading company, for them, they have only finished goods. They don't manufacture, they only buy and resell. Remember, before we determine the selling price, you need to know the cost you incurred, and if you fail to trace costs, then it means that you will not set the right selling price for your products, and therefore life cycle costing helps us to trace all those costs. So we are using the life cycle costing to help us trace all the costs that are incurred throughout the manufacturing stage or the manufacturing phases until we get the finished product. So we are continuing to say that life cycle costing, or the life cycle costs, involve those costs incurred from the beginning of the production up to the end of the life costs. In other words, we get all the costs that we incurred from the beginning of the production to the end of the production process. But what you have to know is that when we reach at the end of the production process, you find that we've got the finished goods, but at the same time, we may get maybe these other residual values or the residual products and other scrap values, scrap products that may come out. They are not byproducts, but you find that we have them. So if you have any scrap or residual values of the product, we are not including that under our costs. But the costs that we include, we have costs such as the maintenance costs, purchase costs, financing costs, and others, which are all summed up in order to give the life cycle costs. So what we normally have, what we normally have under life cycle costing is that we have a simple graph that we use to illustrate the life cycle costs. Because we believe a product undergoes through different stages. And we normally use a curve to show these different stages that a product may undergo. So we know that when you're producing a product, you don't put it at once and you get it there and then in one process. It goes into a process. You first put the raw materials, maybe raw materials are converted to a certain point, then they are transferred to a next process and all that until we get the final product. So we normally have a manufacturing phase, we have a growth stage, we have a maturity stage, and then the decline stage. So those are the stages that we normally have in the life cycle costing. We have the manufacturing stage, we have the growth stage, we have the maturity stage, and then the declining stage. However, in all those different costs we are incurring as a company, they are even we may incur those costs and when we have actually not even got the desired profit in some stages, but we keep incurring those costs. You may find that if, let's say, you are budgeted to get the output you maybe from because what happens in this life cycle costing, we have processes, different stages. You find that from process A, the output of process A becomes the input of process B. So you find that maybe you are planned to achieve more from in terms of the units that are going to come out. But you find that you are planned maybe to receive, maybe you have put in 10 tons of raw materials and you are expecting maybe to get five tons of output from the first phase. And you find that maybe you are the 5 tons you are planned, you have only achieved maybe 4.5 tons. You find that even if you have incurred 4 or you have got 4.5, you can't stop the production process just because you have not gotten what you wanted. Even if the units you have gotten, if you sell them at that point, you will get a loss. We keep going because we can't reverse the production process. We go back and we put that until we get the final product. So even if you incur a loss in a given stage of manufacturing, you have to you have to look at that as a cost that has been incurred, and you keep moving. So to give you a more light on some of these, because we are going to be looking at those different stages that we said. We have the manufacturing stage, we have the growth stage, we have the maturity and the decline. We are going to look at what happens at the manufacturing stage, because that's where we incur most of the costs, because we are producing the original product. So at the manufacturing stage, we are producing the products. Secondly, we have to advertise those products and sell them. And you find that everything is going to happen from there at the manufacturing stage, because we produce the goods, but we don't produce goods for sale, for storing. We produce them, we advertise, and we sell those products that we have produced. And that everything happens at the manufacturing stage. As the company, which is doing the manufacturing, which also does the advertising, the selling of those products that are being produced. Because the reason as why we do so is because we are trying to make sure that the people actually know what to produce even. The people know what to produce, and if you manufacture and you keep these products in the store, then there is more. You are going to find that you are going to see that you're going to be incurring more costs, because if you produce these goods and you don't, maybe you have not gotten the customers who are going to buy them, you have to keep them somewhere. If the number is huge, you are going to end up renting other rooms where you are going to put those materials. But what happens is that we've seen companies which put the commodities on the market when they have already made, maybe you find that they haven't even produced the products, but they are already putting the adverts. They are getting orders before they actually produce the real products. You find that the costs they are incurring for that advertising is to make sure that these items, as long as they are being produced, you find that they produce and they make sure they sell everything. So that's why we incur the advertising costs, so that we can be able to create customer awareness that these products are out. Because by the time, even if most of the times you find that even these companies, they advertise products they haven't produced, or you find that they have put the commodities on the market, but they keep advertising. In other words, they are trying to create awareness that the products are there. In other words, what they are trying to do is to make sure that at least by all means, they make the people ready to buy the products. So you find that at the manufacturing stage, we are incurring a lot of costs. You may find we are incurring a research and development, we do the advertisement. So we keep engaging the public in order for the public to keep giving you their views and other costs that are going to be carry, because by the time you do the advertisement, you expect you are going to get some feedback from the customers. That customers are going to give you what they think, and it may help you to make some adjustments where necessary. So from the manufacturing stage, we believe that customers, they have learned about your products and they are steadily demanding for those same products. Because when there is a steady demand for them, it means we are going to reach to our growth stage. Because if you produce these goods and you keep them, you don't advertise them, there is no way these customers are going to know your products. And if these customers, they don't know your products, it means you are not going to get the money that you want, or you are not going to achieve the sales targets that you've set as a company. It means you will not also advance to the next stage as a company, because we expect that when you produce these goods, you make sure you advertise even before you produce the products. In other words, you are trying to make sure that you convince these customers by the time you produce the products, they are already aware about them. One of the things you can do, maybe someone may be wondering, how can I market something that I did not produce? Some of these products, before they produce them, they first create a budget for the products that they are going to produce. They have this online, they can have, it's just like someone gives you the construction plan. You can see what they are going to do even before they do it. So you have those products, you can have those products, how they are going to be looking like. You advertise them on online platforms. It's mainly online platforms, because you can't move physical, or you can't go on a physical advertisement if at all you don't have the physical products. So if you see that the products you have not yet produced them, go for online advertisement, buy ads, either Google ads, Facebook ads, and all that, so that you make sure that by the time you produce these goods, the customers are already aware about the products, so that when these items go in the market, the customers already know the product they just buy. Even if you put the products in the market, make sure you keep advertising to attract more customers. Because when you attract more customers, it means that you are going to reach at a point that when the demand is more than what you are producing. And if that happens, it means the company is going to produce more. As it produces more products, it means the company is also advancing from the manufacturing to a growth stage. But remember, from all that, we've been incurring costs. Then at the growth stage, because we have an increase in the demand, and even the revenue has increased, because when the demand is high, of course, we expect that you increase the production, and you've been producing, people have been buying what you are producing. It means even the revenue is there. The revenues are there because we have grown our customers, and customers are aware of our brand or the products. Just like the way you're seeing Coca-Cola, the brand for Coca-Cola, everyone knows about it. In other words, even if they reach at a point when their Coca-Cola itself is out of stock, people are already aware that by the time the products comes on market, we are buying, because the brand is already known, meaning that company is acting. If that happens and the steady demand is there and the revenue has increased, it means that we are at a growth stage. So when revenue is growing at the growth stage, then we are not supposed to stop advertising. That's what I'm saying. That if at all you've been, the way you accumulated that revenue, it was because you kept on advertising even before producing the products. So even when the products have been produced and the demand is there. Keep advertising. Because if you keep advertising and you keep doing research and development, you are trying to be innovative, and we are expecting that the company at that stage is continuing with all the innovations. So when you reach at that point, it means that you are advancing now to the maturity stage. So you find that your products have become a household name. Everyone knows about Coca-Cola. Even the young people, they know about the Coca-Cola, or they know about the Pepsi-Cola. If it reaches at that point, it means we have reached at the maturity stage. Everyone knows what the company is producing. In other words, even if you just say Coca-Cola, someone will not ask what Coca-Cola is. It means someone knows what the product is, and knows even what the company that does that. So at that point, we expect that the company has reached the maturity stage. So you find that everyone knows about the product or the brand, and there is no need for you to explain what the product is all about. If you reach at that point, we say, as a company, you have reached the maturity stage, because everyone can recognize your brand or product. So, but at some point, you find that if someone reaches at the maturity stage, or if we draw our curve and it reaches at the maturity stage is like the maximum point. It's at the maximum because everyone is aware of the product. It's the maximum point. You find that at that point, you find that the curve you find that for you to reach at that point, it's not just a one-time phase that you've just wake up, start the business, and it grows up so that everyone can be able to know. It's a phase. You start by manufacturing, you advertise, you develop the demand for the products. From there, you make sure that your brand is known to everyone. So it's a stage. It's not a one-time phase that you just wake up and you find that everything is there. So it takes years for a company to reach each stage. It's not like someone can just achieve today a growth stage and tomorrow you be at the manufacturing stage. It takes time. For example, you may find companies that reach their maturity stage maybe in 20 years' time. You find that a company has reached its maturity stage in 20 years. Meaning they have been there for 20 years for the company to reach at that maturity stage. So that comes as a result of managing the growth stage very well. Because if you don't manage the growth stage, because we've seen there are some companies that can even fail at the growth stage, or some of them are failing at the manufacturing point. You find that they have produced the products, but the products are not moving. It means those products that they produced, if they are not moving, the demand is not there. It means the company has already collapsed, because at the end of the day, if you can't get the demand for the products you are producing, you are already collapsing. If you manage the growth stage very well, the demand has been there, you don't get reluctant and say, I'm not going to continue advertising. You keep advertising so that you reach at the maturity stage. we can only reach the maturity stage when we have managed our growth stage very well. We do the advertisement, we make sure that we reach on every corner of the country or of the any state that we want to penetrate, to make sure that everyone can be able to know the company products and they can easily organize those products. So that can only be done by advertising and doing some research. You do research, you try to be innovative all the time. You keep changing. You don't change the products, but you change certain things that can attract more customers. So we've said that you find many companies that are going to be collapsing at any stage. Someone reaches at the maturity and they start relaxing, you find that they are going to be collapsing. Collapsing means the customers are not going to be buying your products. So what are you going to be doing if you find that the customers are not buying your products? You go back to the drawing board and you see what makes these customers not buy. Is it because of the competition, the price, or the quality of the products I'm producing? So probably you may undertake maybe you may undertake the target costing and find out why they are not buying the products. Because it may be the price. You find that the price is high, the price has changed. Remember, we said in target costing, you go in the field, you find what customers are willing to offer. Then you try and come back to get the target cost. So you may find that they have changed because of the price. You find that maybe the products are outdated. They are not fashionable. For example, if these people who are in the fashion sector, you find that they are buying things which are fashionable, which can be, the technology keeps on changing and things keep on changing. That's why you find that today, if it is Techno, let's say Techno Common 12, let's say Common 12, next time they bring Common 12 Pro, they keep on changing things. So if at all the products are gone, maybe they are outdated, you see how you can be able to update and be able to reach the growth stage or the maturity stage. Sometimes you see companies that reach the growth stage, but they fail to manage the growth stage and they end up going to the decline. Some companies, they are not supposed, you find that they are not even reaching the maturity stage before they go to the decline. They just go straight to the decline stage. But you find that if a company goes or reaches the decline stage, you will see that the company is nearly closing down or it is phasing out also. You find that the business, it is very hard for it to recover from the decline stage, because by default, when the company goes to the decline stage, it has lost its customers. Maybe the loyalty for the customer has also gone. Maybe the brand name is also affected. So you find that it is very hard for the company to recover. So remember, when you are when you're enjoying your profits, and you think maybe you have actually made it, because when these companies reach the growth stage, they start enjoying their profit and they don't care about the company. They stop advertising, they stop doing research, they stop being creative and innovative. You find that they have just kept quiet and they just decided maybe to relax. You find that the efforts which they were using before reaching the growth stage is not actually they are not adding in more efforts so that they can be able to maintain the level they are, whether they are at the maturity or whether they are at the growth stage. Because it's not all that the companies reach at the maturity and goes to the decline. That one we talked about it, you find that some companies just remain at the maturity. When the company reaches the maturity, it maintains that level. It doesn't go to the decline. Because we know that when you reach at the maturity, you have to go to the decline. That's the normal setting. But it's not true that all companies are going to do that. You find that there are those companies that can be able to maintain their level and they be there on the maturity stage without collapsing. You find that the company doesn't stop advertising, even if it has the profits that it wants. So you find that they keep on renovating, just like the way you are seeing Coca-Cola. Coca-Cola has been there for years. And we are seeing, we don't expect, you can't just wake up and say Coca-Cola is going to collapse. It's very, very hard because they keep on changing things. You can see even they made some adjustments on how they were packaging some of their Coca-Cola, the Fanta, they changed the way how the bottle looks like, the way how it was. So it means they are not sleeping. They keep on changing and they keep on changing. So that's the way they can be able to maintain and be at the level they want the organization to be on. But whatever is happening, we are incurring costs because these costs of maintaining a given level, we incur costs. We set at the maturity, we see you find that some companies, when they reach the maturity, because they reached the maturity and they have taken a long time to reach that point. So you find that others are going to be remaining as monopolies or the monopolists in the market because they have reached at that point and they have maintained all their ways. They have done, they keep on renovating, they keep on doing research, they keep on advertising, they are maintaining their customers. At the end of the day, you find that the company comes, other companies comes, but they can't compete with that company because it has maintained its own levels. But these other companies, when maybe you find that they are not even doing sales promotion, they are not doing research, when they reach at the maturity level, those are the companies that you see that they are ending up into the decline stage. So that's what we can talk about as far as the stages of life cycle or the product life cycle. But when you're talking about life cycle costing, we need to track our costs so that we can see how to improve on our products and also see how we can be able to come up with favorable prices for our products. Because if you keep recording all the costs you are incurring at a given stage of production or at a given stage of the or at the given life cycle, you keep on recording all the costs. It helps you to determine a right selling price where you are not going to forget some of the costs and you end up undervaluing or undercharging the customers. And you are not also going to overcharge the customer by charging them higher prices because you know what you incurred in all the processes that you went through. So that's what basically we can talk about if we are talking about life cycle costing. Maybe we can try to look at the causes of product life cycle changes. Someone may be wondering, what causes a change in the life cycle of a product? So these are the things that we are going to be talking about. So the first one, we can look at the rate of technical changes. That is the rate of changes in technology. So if the technical changes take place in a country at a very high rate, then the life cycle of a product in that country will be limited, because new and improved products will take place or will phase out the old products. In other words, here the technical changes, we are literally talking about technology. For example, if technology is very high in the country, you realize that a product life cycle changes very fast. For example, the developed countries, especially, maybe we can look at the developed countries that are specializing in car manufacturing, like Japan, Germany, and others. It is very hard to find people driving cars of the same model. You find someone is driving, or you find people, they are driving cars of the same model 2 years or for 3 years. In those developed countries, unlike maybe in Africa, where you find that the technology is going to be is not all that changing much, and you can have maybe one car model for over 5 years. You find that the model comes and it is the one they know for the 5 years. But for these developed countries, you find that in just maybe in 1 year's time, you find that they are introducing another model. They keep on changing the models. So if the technology is high or is changing at a very higher pace, then we expect the life cycle of the product to change also. So that's the first one, or the cause of the product life cycle changes. The other one, we can talk about the rate of market acceptance. If the customers of the country accept a new product very fast, the life cycle of the product in that country will be limited, because the customers who have accepted the product very fast can easily switch from one product to another. In other words, if the market can respond very fast to these new products that are going to be produced, if let's say when you produce maybe a product today, and tomorrow you produce another product, and we see that the market is responding very fast to that new product, it means there is a higher rate of change of market, a higher rate of market acceptance in the country. So that will make this life cycle of a product to be very, 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 very limited. In other words, the product will not take long. It will get off very fast, because these customers, they keep switching from one product to another. So if maybe maybe today you say maybe you launch a product, and tomorrow maybe you launch another product, just like what we have been saying, you find that if customers are going to quickly switch from the old product to a new product, then it means they will forget about the old product or the old one very fast, and hence phasing out with time. But if at all we have maybe where if at all we have markets where customers they don't normally switch products from one product to another, then and we see that maybe these customers they first of all first started the new products and they know what the product is and what it offers before they switch, then it will it will create it will provide a higher product life cycle, because these customers will take a lot of they will take long time when they are still studying the product to see how different is the product you've launched today from that you launched yesterday. So if that happens, then we are seeing that the product life cycle change is not going to be all that high. So the third one is the ease of competitive entry. If the competitors can easily enter into the market, then the life cycle of the product will be very short or will be very limited, because competitors they come with the similar products. So when there is ease of entry in the industry, we find our products, maybe you find our products life cycle will be at a threat, because today you find that you can say you start making phones, and you find that it is very easy for other people also to make similar phones. So when that happens, you find that there is going to be a higher competition, and hence anytime a given brand can be phased out quickly because of the different alternatives that are there because of the competition, and this lowers or shortens the product life cycle. But for the restricted entry into the industry, like for example the Microsoft, you find that it's Bill Gates who is the entry is restricted. You find that customers have no alternatives. And if the customers have no alternatives, it means the product life cycle is going to be high, because the product is going to take long, because no one is allowed to enter into or to penetrate into that market to dilute it. So since that is going to be happening, it means the product is going to be there for long. That's why we are seeing Microsoft has been dominating all these, because the software stuff has been restricted to some extent. So maybe you can try to look at the strategies or what could be the solutions to the causes of the product life cycle changes, or what strategies can we implement to extend the product life cycle. So here I want to see that our products are going to be in the market for a very long period of time, because when products are there for a long period of time, that means it has a very long product life cycle. And these are some of the strategies or what we can do to make sure that a company which is maybe at the growth stage can be able to advance to the next stage, or the company which has been at the maturity stage can be able to be at that point for a long period of time before declining. So One is advertising. We've been talking about advertising because what we need to understand here, we want to see our products that are when they are going to be there on the market for a long period of time. So when we do this advertisement, because advertisement is going to be intended to gain a new audience or remain with the current audience and the potential customers about the existing product. It means that we are going to have more customers that are going to be buying our products, or we are going to maintain those customers that we've been having. So the second one is price reduction. Price reduction, this is more attractive to customers since majority are attracted by price cuts and discount tags. When you most of these people buy products in the supermarket, they buy more of. You find that the supermarket will attract more customers when they have maybe given certain discounts. You find that they are going to be more customers who are going to come in to buy those products because there has been a price reduction, or they have given them some discounts. That's why for a discount, you find that the more you buy is the more you enjoy from the discount. So if you reduce the price of the product, maybe you can reduce by giving maybe bonuses or discounts to customers, then you can be able to attract more customers. The other thing you can maybe do is adding value or additional value. You add the value to the products. That is another strategy of adding value to the product. This involves adding new features to the current products, like improving the maybe product specifications to enhance stability and attraction, or attract the attention of the wider customer base. It is also a strategy. When you add value, though it's not here, it's not on our notes, but you can also add value. Then the other one, we can explore new markets. This involves selling products into new geographical areas or creating a version targeted at different customer segments. So you can also decide to go out and think about the areas where you can widen your customer base. For example, if you realize maybe, for example, you may try to look at maybe Coca-Cola, Pepsi-Cola, and these other new companies that are within the beverages, the soda making industry. You find that Coca-Cola and Pepsi-Cola, they dominate most of their products are being sold within the Kampala region or the central region. But you find that the products of Liham Cola, they are not more in the central region, because in the central region, we find that geographical area is having a lot of competition from these two competitors, the Coca-Cola and the Pepsi-Cola. So what you've seen that what Liham Cola did was to make sure that they capture the village areas. You find that there are more products of these Liham Colas than the products of Pepsi-Cola and Coca-Cola. I'm not saying those ones, they are not there in the villages, but they are there, but they are not as much as what Liham Cola did, because for them, they saw in Kampala or in the central area, they cannot capture the market. So they went and selected the different geographical areas in rural areas. So you find that the products there, they are more as compared to their products or the consumption pattern for their products within the central region. So it will be one of the ways, because when Riham Kora did that, it is also getting its customers. Even if the central people, they are not that buying, but we are seeing that the company is still standing and doing better because they looked at a new geographical area where they can compete favorably. So the other item we can look at is, or the other strategy can be the new packaging. Just like what I told you, that Coca-Cola improved their bottling, their Coca-Cola bottle. They changed it. It used to be a little bit short, so they remodified the bottle, and it's now looking like the bottles of these other competitors. So it's also a new strategy whereby you can maybe try to add in some new changes, add in some new features that can help you attract, or that can influence the target customers to come and buy the product. Because just like the way you see these detergents, they almost changed its packaging and they brought something that is a bit brightening, and you can be able to see that what they are trying to do is they are laying a strategy to attract more customers. So packaging can also work by changing maybe the shape. You can also change the shape, and you maybe put, just like what Coca-Cola did, to change the bottle, the Coca-Cola bottle to the plastic one to a different, which is different from the old one. Or it can be you change the other features, the packaging features. You add in some features that can help you attract more customers. Then the other one is, the last strategy we may look at is sales promotion. Of course, most of the time we are just trying to raise the customer's interest by offering maybe jackpots, just like the way you're seeing Jumia. Jumia has Black Friday, where you're seeing that prices are going to be reduced, but it's going to be there for maybe once in a week. It's a Black Friday that you see people are going to buy. The prices are going to be maybe a bit lower. So you find that people are going to be many that are going to be buying because of the promotion. So that promotion also works for organization where you can get maybe once in a year or once in a month, and you do a special promotion, just like what we said, maybe Black Friday on Jumia, where you find that prices are nearly reduced to 60%. You press it from the price. So that's what we wanted to do as the theoretical aspect. But since we have gone into that and we have seen all that we need for the life cycle costing, let's try to look at a practical number that requires the use of both the target costing and the product life cycle, and we'll be able to improve on our understanding of the applicability of these costing systems. So that's what we are going to be looking at in our next video. It's going to be December 2020, question 5. So for those who haven't subscribed, please do. Make sure you also hit the notification button so that you can be notified whenever we upload a new video, so that you can be able to have a series, because these we said they are series. In other words, you're not supposed to miss anything, because we start from we go on a step by step, and we'll be able to see what we can do to improve our understandings. So that's all for today. Until we meet again, it's bye for now.